Our best-case scenario predicted a windfall of $1.5 million in 5 years. Thus, the year 2027 would have passed. Time is not yet wasted. Even now, we believe that will turn out to be correct. Institutions must treat Bitcoin like a fiduciary if they want to invest in this new asset class. The correlation of these returns is extremely low when compared to other assets, which is what the code words new asset class imply. More so now when bond and stock prices are moving in tandem, you must. Separate from the other. Without a doubt, yes, without a doubt. This means it needs their consideration. Here we are, what? Is expressing? The maximum number of Bitcoin that will ever be in circulation is 21, and there are currently 19.6 million. There is in fact value in rarity, so what's the plan? Compared to a year or two ago, the price increase for each institutional dollar coming in now will be far bigger. If these establishments are serious about wanting to own it, we will investigate. What I found interesting recently, I only found out about it this morning, is that long-term holders, a measure we track, usually show up when prices go up, like when the price of Bitcoin goes up. It's a measure for on-chain analytics that indicates the number of users or wallets that haven't transferred Bitcoin in 155 days or more. Yes, typically when prices experience a strong upward trend, such as the one we've witnessed in the past year, it often leads to a subsequent downward trend. And it did, as expected, but it has now turned around due to the fact that we learned BTC sold some of their Bitcoin. Those wallets must have remained unchanged for quite some time. No, now that it's out of the way, for the time being, it will rise again in tandem with the price. Wow, that's really strange. This new asset class is causing long-term holders to think twice before selling. This is because these institutions, which currently own nothing in this arena, are forced to explore it due to the fact that it is a new asset class. In her most recent prediction, Cathie Wood pegs Bitcoin at $600,000 in the base case and $1.5 million per coin by 2027, a figure that has attracted a lot of attention. Wood's observations extend beyond quantitative data. She thinks of Bitcoin as a revolutionary asset class that is changing the way we think about money, not simply a cryptocurrency. Bitcoin, in her view, stands for an alternative to conventional money, a decentralized, worldwide, privately run digital currency based on rules. In addition to talking on the effects of Bitcoin, Wood offered her thoughts on the future of Ethereum and Bitcoin and the continuing argument between the two cryptocurrencies. Beyond cryptocurrency, Wood investigated the merging of artificial intelligence and technology, foreseeing a day when the two will have a major impact on our planet. Chris Berniski, our first crypto analyst, left to create Placeholder in 2017, a time when Bitcoin was trading below $1,000 and a civil war was raging between Bitcoin maximalists and Ethereum network advocates. He came to the conclusion that the Bitcoin and Ethereum advocates should get together at our workplace and that they should establish ground rules. Bill, as the room's adult, established the Ethereum side's tone. I immediately went out and purchased Ether since our conversation was so fruitful. It was so persuasive that there is a place for both that I already acquired a lot of Bitcoin. We both have our uses. Indeed, Solana and the Ethereum network are incredibly exciting to us. Consequently, they each perform a unique function. What I really enjoy is that there is a hint of rivalry. In my opinion, rival networks are kept honest by healthy competition. After we clear the dust from the gears, we believe in decentralized finance, which we now refer to as the internet financial system, and cutting out the middlemen. Yeah, at least our digital wallet was functional. The number of steps involved in a transaction between a customer and a business is something we're attempting to quantify. All told, there were 9 steps, not counting the 2. Even though there are a lot of intermediaries, these were the simplest. Plus, if you use middlemen, credit cards, etc., every purchase you make is subject to a tax of 2 to 4%. So consider how drastically lowering that tax rate will expand availability. First, when we apply the Wright's Law to industrial robots, we find that their costs drop by half for every doubling of the total number of robots in use. This leads us to believe that this sector will experience the fastest growth in the next 6 to 7 years, even outpacing AI. From the perspective of market valuation, this is now. Here I'm referring to its monetary worth. We anticipate a compound yearly growth rate of over 80%, with disruptive innovation as a whole expanding 40% from the current public and private market capitalization of around $20 trillion. To round things up, our venture fund has invested in AI. The difference then will be between 20 and 220 trillion by 2030. The exponential growth rates will be accelerated by the development of generalizable robotics, which will lead to a 40% compound annual growth rate. To clarify, I can explain the reason for that. People are afraid and clinging to benchmarks because they do not want to go through another tech and telecom bust, which I briefly touched on in the reasons. A repeat of the financial crisis would be disastrous for them. This is just another tech hype cycle, apparently. Therefore, at the moment, they are words that activate them. Now, we can see the irony. I was around in the late 90s when investors began basing company valuations on the amount of potential users' eyes on a website over the next decade to 2 decades. There was a time when a single travel agency was well worth exceeding the combined capacity of all carriers, and that is all. So there was an excess of capital seeking an insufficient amount of. Chances came too quickly, and it was a disastrous finale. Both the technology and the costs were too high. The computer and telecom boom burst 20 years ago, but few people realized that this was just the beginning. They've been waiting 25, 30 years to germinate. Unlike in the late 90s, they're fleeing as we get ready for the big time. They're fleeing in all directions. The hills, what are they? Those are the standards. Here we have the question that comes up frequently. Could this be a bubble? Our current position is that this does not constitute a bubble. Look at this. There's a thing. Did electricity exist in a vacuum? Yes, exactly. Yes, exactly. Does everyone seem to be after the same thing when it comes to capital? It is possible. I can tell you that we've been backing away from Nvidia mostly because we see how well understood that story is. I'm not saying anything new, but it's been in the media. True enough. Finally, Jensen Huang and his fantastic crew deserve our highest admiration. They've really pulled their weight as we've progressed to this point. On the other hand, this is where our portfolio's underappreciated and unappreciated AI-enabling companies shine, those with extensive domain knowledge, particularly in the multi-omics space, one of your favorite areas, Peter. Subject matter experts and artificial intelligence specialists, please pay close attention. Good distribution, winners and losers, solo and with partners, will be decided by this. At last but not least, the most critical step is making use of a company's proprietary data, which is information that remains private, and while ARKW gets the lion's share of attention when discussing artificial intelligence, the technology will eventually affect every industry and corporation. Our flagship strategy also incorporates multi-omics. Even though multi-omics is currently quite unpopular, we believe that it will have some of the most significant AI applications in the future. There has been a massacre in the biotech stock market. Yeah, and let me tell you, the critics go absolutely bonkers whenever they witness the sale of Nvidia and the acquisition of Recursion. Just so you know, Nvidia's venture firm is quite selective about the companies it invests in, particularly in the health sciences industry. Unaware of the situation, they fail to grasp the fact that Recursion is achieving better outcomes in drug discovery as a result of AI and Nvidia. Returning to the previous point, I believe that the current state of affairs is the result of the merging of multi-omics sequencing with artificial intelligence, which is leading to new discoveries and the unraveling of the mysteries of life, death, and disease. However, if our estimations are correct, the number of failed trials will decrease by something like 75%. This is one of the more pragmatic things that, in my opinion, surprises those working in the research industry. Additionally, that will uncover a ton of resources, really useful resources that we don't think people fully get. So we have open source vs closed source. OpenAI, hey, we should call it closed AI, was just something Elon was saying in the spaces. The major concepts, however, are here again. You can see the relative speeds of performance gains from open source and closed source models in the accompanying chart. Now, GPT-4 is just floating around on the level. It's unmatched by anything else. However, the open source performance improvement line has a greater slope. That's progressing more quickly. I often say that the Bitcoin blockchain is like a gigantic neighborhood watch, and I'm wondering